Good afternoon and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Just a reminder that anyone that is registered for today's program will be receiving a copy by early next week. And if you have any questions, be sure to enter them into the lower right-hand side of your interface. Joining us today is our good friend, Kerrigan Advisors founder and managing director, Erin Kerrigan. Erin, I know you have a lot to get to today, and I'm excited for this presentation, so I'm going to let you take it away.
Okay, thank you, Rachel, and thank you as always, AIADA, for inviting me to speak about the tremendous buy-sell activity in 2026 and the results of Kerrigan Advisors' annual OEM survey, which was just released yesterday. For those who have not received a copy, you feel free to reach out to me directly at erin@kerriganadvisors.com, and I'm happy to email you the survey results. Today's discussion is informed by Kerrigan Advisors' vast experience leading auto retail's buy-sell market with over $10 billion in client proceeds in just 12 years from the sale of more than 325 dealerships, representing 435 franchises in 30 states. All of this client work helps to inform our analysis of the marketplace and, of course, our Blue Sky Report, which is now received by over 16,000 industry participants in 35 countries. We attribute our firm's success to our team's laser focus on working together as a team to achieve each of our clients' goals and because of our pure play approach to the marketplace. Kerrigan Advisors is the only firm in auto retail dedicated exclusively to sell-side advisory of U.S. auto dealerships. We like to say, others have conflicts, we have your interests. With that backdrop, let's jump into today's discussion as we have lots of data to share. We thought it only appropriate to employ a 4th of July theme to our presentation. The record-breaking weather that our nation's capital experienced to mark its 250th birthday certainly reminded us of the records the buy-sell market continues to reach, hitting a new high in the first quarter of 26, resulting in 478 transactions completed in the last 12 months. Now, despite economic uncertainty due to the conflict in the Middle East, high gas prices, vehicle affordability, and interest rates, not to mention the lapse of USMCA and our tariff policies, which seemingly are always in flux, in the first quarter of 26, and frankly also in the second quarter, we saw tremendous activity. The first quarter had 114 transactions, which were completed, representing 159 franchises. Based on the closings we have scheduled for the remainder of the year, Kerrigan Advisors expects the 2026 buy-sell market could surpass 500 transactions and hit a new record for franchises sold. In our experience, today's buy-sell market has more buyers than sellers. Many dealers are seeking expansion, believing that scale, particularly on a local and regional basis, will be critical to future success. Today, these buyers are more confident in their expansion strategies now that industry earnings on average have stabilized, normalizing 87% higher than pre-pandemic averages. And sales also are at all-time highs, as you can see on the line on this graph, leading many well-funded buyers to seek transformative multi-dealership transactions that dramatically expand their footprint. Through the first quarter of 26, 108 group sales were completed in the last 12 months, 80% more than what we averaged pre-pandemic. This elevated level of group sales is partly driven by more dealer families exiting the industry as their succession plans run their course and estate planning becomes their priority. And the majority of OEMs expect today's elevated pace of buy sales to continue or even accelerate, according to Kerrigan Advisors' 2026 OEM survey of over 100 OEM executives, the largest of its kind. 53% see buy-sell activity continuing at today's elevated pace, while 35% project an increase over the next 12 months, a strong endorsement of the continued strength of the dealership buy-sell market as we enter the second half of 2026. Keep in mind, these folks see the buy-sell, so they do have a purview into what they expect to close in the next 12 months. So this is very good data. Amongst the franchises that are trading hands, the domestics saw a significant uptick last year as their brands benefited from U.S. tax and tariff policies favoring U.S. manufacturers. Now, that being said, in the first quarter of 26, which to be clear is just a quarter's worth of data versus a full year's worth of data, import non-luxury franchises had a significant uptick to 40% of the franchises sold, almost double their franchise market share, which is in the red square. Generally speaking, imports are disproportionately represented in the buy-sell market relative to their franchise market share because they are the highest demand franchises and have the fewest number of franchises. When we dig deeper into the top 10 franchises sold last year, you're going to see a trend we highlighted in our annual Blue Sky report, which is the rise in dealership groups divesting of weaker performing franchises. As you can see, Stellantis had the highest share of the buy-sell market in 25 at 14%, whereas Nissan led the import segment with 6%. These franchises are the top divestiture candidates in the marketplace today. Of course, to sell a franchise, you need a willing buyer on the other side who sees an opportunity. Clearly, that happened last year. As an example, Kerrigan Advisors sold 3 Stellantis dealerships on behalf of Asbury Automotive Group in the Salt Lake City, Utah market, and those were sold to local buyers who were excited to pick up the Stellantis franchise and expand their footprint. Consistent with that Asbury deal, the primary buyers last year, and we expect this year as well, were smaller private groups seeking to expand their local and regional market share. 79% of buy sales were completed by these groups who were focused on scaling up their organization. While the largest dealer groups, both public and private, represented only 21% of the buy-sell market in 25, that's 10% for the publics on this chart and 11% for the top privates. This smaller share is a bit misleading because it's referring to rooftop rather than capital allocation. From a capital allocation standpoint, the larger groups disproportionately represented a much larger share of the market. Of course, we don't have the specifics on how much each deal costs and prices, but we do know that these top groups actually have a disproportionate share when you look at the capital spend. They're doing deals like Herb Chambers, which was $1 billion deal. In 26, we are seeing fewer divestitures in the marketplace as many of the top groups are done pruning their organization. Instead, the largest groups are leaning into acquiring the top franchises, resulting in a significant uptick in their buy-sell market share in the first quarter, as you can see here. Valuations for the industry's most desirable franchises continue to increase, with certain brands, including Toyota and Lexus, achieving record blue sky values this year. These historically strong valuations are bringing more sellers to market. One thing we continue to see playing out in 26 is buyers' strong preference to buy local. 60% of the franchises acquired in 25 were located within buyers' existing markets, demonstrating the importance of geographic density and local market share growth, and that very much continues in 26. In terms of the markets in highest demand, the southern region of the U.S. remains by far and away the leader, and this is consistent with Kerrigan Advisors' buyer network, which skews heavily to buyers seeking dealerships in the south, where valuations are usually higher than the other regions of the country. This brings me to valuation trends we are seeing in the market. The Kerrigan Blue Sky Index, which has a baseline in 2019 at 100, remains 78% higher than its pre-COVID levels and has been rising since 2024 after correcting from its COVID high. Kerrigan Advisors sees valuations on average to be in an upward trajectory because the supply of dealerships for sale, while certainly increasing, is not rising to a level that meets current buyer demand, thus putting pressure on values, upward pressure, particularly for the highest demand import franchises. This upward valuation trajectory is consistent with the results of Kerrigan Advisors' 25 dealer survey of over 600 dealers, the largest of its kind, where we saw a notable rise in dealers expecting an increase in their valuation and a significant decline, this is the turquoise line on this graph, in those expecting a decrease. Our just released OEM survey also supports this perspective. 61% of OEM executives expect today's high values to either continue, while 21% project an increase, up from 2025 when 22% expected a decrease in blue sky values, as you can see on this chart. Now, keep in mind, these folks, again, actually see all the pricing when they are approving buy sells. So their perspective is based on the data that they see. With that overview of today's buy sell market, I thought we would look at the current market trends from both the buyers and sellers' perspectives, starting with the sellers, many of whom are focused on industry risk factors, seeing potential calamities instead of a celebratory fireworks display for their privately owned businesses in the future. These dealers, like Roger Penske, recognize that we're not in the old car business and that significant change is coming fast. Alex Partners, a consultancy, ranks automotive as the industry most likely at risk for major disruption in 26, underscoring why some dealers are evaluating exit strategies, particularly as average valuations are on the rise. Some of these dealers are worried about the longevity of their valuations, particularly if you look at the volatility and recent declines in the public stock prices. The Kerrigan index of the 6 publicly traded auto retailers is down over 8% this year. Wall Street appears to be reacting to both rising gas prices and the impact of the war in the Middle East. Combine this risk factor with the challenges of affordability and record negative equity, which is up 80%, certainly an unfortunate hangover from our COVID era price premiums. And some dealers are concerned that their future earnings could decline and thus are deciding to capitalize on currently healthy buy sell markets before blue sky potentially gets repriced. And while service and parts continues to be a very key driver of dealership profitability, there is some question as to the sustainability of that growth given affordability challenges in today's market, since most of the growth that dealerships are seeing is a result of higher prices, not more ROs. You can see here that RO counts are down considerably, about 14%, while revenue per RO is up 64%. With these price premiums, new car dealers are actually losing market share to independents industry-wide, which is not likely a good long-term trend. Now, in addition to affordability concerns, AI is promising to revolutionize retailing as we know it and could result in a complete re-engineering of most of a dealership's business processes, from sales to accounting to service. Perhaps the best early indicator of AI's impact on our business is Carvana's entry into the new car segment. Carvana's business model is built around centralized operations, digital retailing, and the heavy use of AI to improve inventory management, pricing, and customer acquisition efficiency. This results in 30% of their car buyers and 60% of their car sellers completing the entire transaction without interfacing with a single Carvana employee. Now, this technology-enabled business model results in sales per retail location of $598 million, more than 6 times the average revenue per dealership for the top 150 dealership groups. This is why Carvana's market cap is greater than all of the public dealership groups combined, as well as Ford and General Motors. Now, and they are actively expanding, as we know, into the new car market. They have done 7 acquisitions in the last 15 months. To demonstrate the power of their AI-driven sales model, which operates with roughly half the personnel expense as a traditional car dealership, let's look at the first store they acquired, a Stellantis franchise in Casa Grande, Arizona, a periphery market 50 miles from Phoenix City Center. When Carvana acquired this store, it was selling 35 new per month. In June, just last month, it sold nearly 1,000 new vehicles without a general manager at the store or any commission sales associates. That's a 30 times increase from when the store was acquired in February 25. Carvana's sales momentum is partly driven by its ability to accept lower grosses because its operating cost structure at the dealership level is so much lower. This store is tracking to be the second highest volume dealership of any U.S. make in the country, a pretty remarkable turnaround. For some dealers, the idea of revolutionizing the way they do business to compete with these new AI-enabled retailers seems a bit daunting, and many realize they will need significant size to manage this transformation. Thus, the viability of owning 5 or fewer dealerships seems unsustainable in the future and is on the decline, as you can see here, the turquoise line, while groups with 11 or more stores have doubled their market share since 2018. But it is not just rooftop count that matters today. It is also revenue per rooftop. As you can see here, the top groups have significantly higher volume per dealership. Like Carvana, they have discovered that scale is most meaningful on a rooftop level. That is where profitability really soars in auto retail. Interestingly, while it seems that we are still a very fragmented industry with 16,000 dealerships and 6,000 owners, just 31% of dealerships represent 64% of the total industry new unit sales. As AI becomes a bigger part of the sales equation, we will likely see more of our industry sales concentrated in fewer and fewer dealerships, making it harder for smaller dealerships and dealership groups to compete. To further highlight this dynamic, the top 150 have increased their revenue by 85% since 2014, but only increased their store count by 41%. At their current rate of revenue growth, these 150 dealers are tracking to represent more than 50% of industry revenue by 2040, less than 15 years from now. So the key is not just to have scale in terms of the number of stores, but also in terms of revenue per rooftop, because that is going to drive profitability. Many dealers are realizing it will be increasingly difficult to compete with high volume groups and stores who accept lower margins on vehicles because their cost structure is lower as a percentage of revenue. This will feel a bit like a race to the bottom for some dealers, sort of like the effect Amazon had on many legacy retailers when they entered the marketplace. The days of holding gross are disappearing and making the car business a lot less fun for longtime dealers, driving more families to decide to sell. Particularly knowing that OEMs are also messaging that they want fewer larger dealer groups in their networks. According to the 2026 Kerrigan OEM survey, 45% of OEM executives expect to have fewer dealers in their network over the next 5 years, up from 33% last year. With facility requirements becoming ever larger and, quite frankly, less economic, OEMs are clearly seeking deeper pocketed dealers to build their ever more expensive showrooms. Reinforcing this trend, Kerrigan Advisors asked OEM executives in our survey whether their organization will require a new image facility of their dealers over the next 5 years. 43%, almost half, of respondents indicated they will, underscoring the rising capital demands placed on dealers and the pressure that these requirements create, particularly for smaller operators with more capital constraints. Now, another concern of some sellers is the existential threat presented by China's rising share of the global auto industry. Since 2019, Chinese OEMs' global market share has risen significantly at the expense of legacy OEMs. While we do not see these vehicles on the roads in the US, the Chinese economic impact on our legacy OEMs is evident in many OEMs' declining earnings as they struggle to compete with Chinese manufacturing and technology advances. Lower earnings means less ability to invest in new products and can create a downward spiral, as we have witnessed with Nissan, VW, and Stellantis, who have lost the most market share to the Chinese OEMs globally. Okay, with that admittedly dour view from many sellers, let's talk about the buyers, many of whom are a much more optimistic group, reveling in auto retail's bright future. They know, in particular, that auto retail has always demonstrated its ability to remain consistently profitable and provide a high return on equity, even during the most challenging of economic cycles. In the depths of the great financial crisis, the average dealership remained profitable and achieved a 10% return on equity. Today's return on equity is 28% on average, a very high rate for any business, and industry profits, as discussed earlier, are leveling higher, even on an inflation-adjusted basis. While there are certainly hyperbolic headlines regarding the consumer and their financial woes, buyers see an underlying U.S. economy that continues to demonstrate attractive fundamentals, including a low unemployment rate, strong job creation, and perhaps most importantly, record business creation, largely due to AI's transformative power. Furthermore, while vehicle affordability is discussed at length in the press, the reality is that new vehicle affordability has improved in 26 as a result of rising wages, steady interest rates, and increased incentive spending, as well as, of course, longer loan terms. These buyers also see an industry that still has pent-up consumer demand given an aging vehicle fleet and the lost sales from COVID. In fact, we continue to hit new sales records, particularly on the retail side, where 14.5 million vehicles were retailed last year, resulting in record industry revenue of $1.3 trillion. They also see more OEMs on the whole exercising better production management and implementing a key lesson from the pandemic, which is that less is in fact more. With days supply sitting at 76 at the end of May, far below the pre-COVID average of 90 days. Further evidence of this improved inventory outlook, our survey results showed that more OEMs expect a 30 to 60 day supply in the next 12 months. That's the rising turquoise line here, and fewer expect a 60 to 90 day supply. This improved manufacturing discipline is resulting in sustainably higher new vehicle grosses on the front end, and when combined with rising F&I grosses, is resulting in a higher normalized new vehicle gross profit level. And while many were concerned about the impact of tariffs on gross profits, it appears that the OEMs are absorbing the majority of those expenses, with 58% of the OEMs we surveyed expecting that to continue. You can see only 5% thought that the dealer would absorb the majority of the expenses associated with tariffs. Now, combine this with a projected increase in used vehicle sales as supply finally rebounds due to rising lease returns, and buyers feel the near-term profit outlook for auto retail is quite strong, particularly as a high-margin fixed operations business does continue to grow, albeit not due to RO count, as I've previously pointed out, but rather supported by an increase in OEM's recalls, which do not seem to be abating anytime soon. These positive earning dynamics, combined with the projected cost savings consolidators expect to achieve with AI, as well as the revenue generation they can gain by implementing AI solutions, is further enhancing buyers' outlooks. And Kerrigan Advisors OEM survey results support this positive perspective. 59% of OEMs project dealerships will be more profitable in the future as a result of AI. And 90% of dealers surveyed in our dealer survey are either implementing or plan to use AI in the future. With these attractive earnings expectations, it is not surprising that the largest dealership groups are seeking to add to their portfolios, particularly since most are flush with cash. The publics, for instance, have over $7.5 billion of capital available for acquisitions, even after spending more than $4 billion in 2025. Cash is not a constraint for growth, especially with the strong cash flow of today. Wall Street largely agrees with buyers' positive industry outlook. The Kerrigan index is up 118% since January 20. And while recently more volatile, as I noted, in 26, it did hit record highs multiple times last year, with Asbury, AutoNation, Group 1, and Sonic all achieving record market caps in 2025. Investors see tremendous growth potential for the largest dealership groups to continue consolidating the historically fragmented auto retail sector. And the publics keep demonstrating their ability to grow through accretive acquisitions. Last year, spending the second highest level on record, committing $4.4 billion to the effort. In terms of where the publics are investing, 94% of transactions were completed in markets where they already had a presence. The exception being the Herb Chambers deal, which was a billion-dollar platform entry into the New England market by Asbury. This acquisition activity speaks to the shifting growth methodology of the largest groups, who are primarily seeking to dramatically increase their market share in their existing markets, both local and regional, and will only enter a new market if the acquisition positions them with significant scale upon entry. To this point, we find buyers' growth strategies are increasingly shifting from what might be described as a game of checkers to a game of chess, moving away from broad opportunistic expansion towards more deliberate and strategic decision-making, ensuring they are taking the best chess pieces off the table in the markets in which they operate. To that point, the public's recent acquisitions are heavily skewed toward import luxury, 62% of their acquisitions, with Mercedes and Land Rover being the most acquired franchises in 2025. The publics are ensuring they own all of the top brands in each market in which they operate, and often will pay the highest multiple because they can pro forma significant cost savings post-transaction and have a long-term view of these investments, not to mention a lower cost of capital than most private buyers. As further evidence of the public's demand for the top franchises in their existing markets, the public's average acquisition price per dealership in the first quarter rose to nearly $200 million, up 253% from their average last year. The first quarter spending included the epic Penske record-setting $670 million purchase of just 2 Lexus franchises in Orlando, Florida, the most ever recorded in our estimation for 2 dealerships. Now, as the largest buyers become increasingly strategic, the top growth metros in the U.S. have very few premier assets left to acquire. In Charlotte, for instance, 85% of the top franchises are already owned by the top 150 groups and will not likely sell again unless one of the privates, the top 150 consolidators, actually sells their entire enterprise. With such a small number of top franchises available for purchase, this creates a significant supply-demand imbalance in these markets in particular and results in very high price premiums. Most recently, Kerrigan Advisors announced the sale of our client Paramount Automotive Group's Foreign Cars Italia platform in Charlotte and Greensboro, North Carolina, to Hendrick Automotive, which included Porsche in Greensboro and Ferrari in Greensboro and, of course, Charlotte amongst the franchises sold. That transaction, consistent with the theme that I've discussed on this slide, shows that consolidators are ensuring they will not miss out on the best franchises in the market in which they operate. Mr. Hendrick was going to own that Ferrari franchise in Charlotte no matter what. This slide also speaks to the higher level of consolidation we are seeing in top metros. While the U.S. still has 6,000 car dealers, the top growth markets are seeing their dealer count shrink at a much faster pace than the nation as a whole. The final topic to bring up from the buyer's perspective is the decline in OEMs using ROFRs, which is allowing for a more market-driven consolidation process. In our OEM survey, we saw a significant decline in OEMs expecting to ROFR 25% or more of their buy-sells, going from 28% of respondents in 25 to just 8% in 26, a positive for active acquirers. This brings me to the final section of my presentation, and that is a review of blue sky multiples. While on a macro level, blue sky values have been rising and in some cases reaching new heights, on a granular basis, there is greater divergence with big and small fireworks occurring at the same time. To this point, it has never been more important to have a diversified portfolio of franchises to mitigate the impact of a poor performer. Another reason many dealers are seeking to grow. On one side of the market, high-performing franchises, particularly those with disciplined inventory management, high sales per franchise, and dealer trust, continue to achieve strong buyer demand and are projected to increase in value by dealers according to our dealer survey. The folks on the left-hand side of this graph. On the other side, weaker franchises are seeing reduced buyer interest and lower blue sky values. The franchises primarily on the right side of this graph. Buyers' diverging perspectives on blue sky is now a defining characteristic of the buy-sell market, with winners and losers, much like the K-shaped economy. Another example of the performance extremes we are witnessing is the difference in days supply in 26, with Lexus at 34 days and Stellantis at a whopping 142 days at the end of May. In fact, as you look at the delta between the top and bottom performers, you can see that this is the highest gap we have seen since 23, a clear indication of the exacerbating performance divide. So while the average day supply is attractively low, as I discussed earlier, it can be misleading because there are extremes on both ends of the equation. In terms of the franchises dealers are seeking to add, according to Kerrigan Advisors Dealer Survey, Toyota leads in the non-luxury segment, with 40% of dealers seeking to add a Toyota franchise, more than 10 percentage points above second place Honda and Subaru. The demand for Toyota franchises is quite frankly insatiable. In the luxury segment, and at no surprise, Lexus remains the highest demand franchise, followed closely behind by Mercedes and BMW. Before I review our recently published blue sky multiples from our first quarter report, I do want to remind everyone how these multiples should be applied, especially since this changed quite a bit during the COVID years. With earnings now stabilizing, buyers have returned to applying blue sky multiples to the most recent performance of a dealership and are no longer averaging prior years. That said, they are adjusting multiples to reflect the specific circumstances of a franchise, with these 7 drivers here ultimately determining whether a multiple should be moved up or down, sometimes several turns higher or lower depending on the situation. Today, we find earnings growth expectations, geography, and real estate to be the most influential drivers of blue sky multiples. And in certain markets, like Florida, Texas, and the Carolinas, where supply is limited and demand is very high, the blue sky multiples are often several turns higher than what we publish in our report. In the non-luxury segment, Kerrigan Advisors increased 4 blue sky multiples last quarter, specifically for Honda, Chevrolet, Ford, and Buick GMC. All of these franchises are experiencing improved buyer demand as a result of strong projected future earnings. In the case of Honda, the franchise has regained its position as one of the most sought-after non-luxury brands, driven by industry-leading hybrid sales, disciplined inventory management, and strong buyer sentiment. In the case of Chevrolet, Ford, and Buick GMC, these 3 domestic franchises greatly benefited from the One Big Beautiful Bill and its bias toward U.S. manufacturers and manufacturing, and they were the most improved performers in Kerrigan Advisors' 25 dealer survey. When looking at our multiples as compared to a dealer's trust level, you can see a very high correlation. The more a buyer trusts a franchise, the more they are willing to invest in blue sky. Because at the end of the day, blue sky is a completely intangible asset, clearly a trust equation. While the franchises on the left-hand side of this graph can often be highly profitable, the drivers of that profitability from a buyer's perspective are usually the operator or location rather than the OEM. Thus, the franchise multiple is lower because the franchise is not driving value, rather the operator or geography is. In the luxury segment, Kerrigan Advisors increased 3 multiples this quarter, namely that of Lexus, BMW, and Cadillac. In the case of Lexus, its blue sky multiple increased due to record dealership level profitability, rising dealer trust, and disciplined inventory management, which led to high vehicle gross margins. BMW's blue sky multiple increased this quarter as strong dealership profitability, exceptional products, and disciplined inventory management reinforced buyer confidence in the franchise's long-term earnings growth prospects and premium brand position. Finally, Cadillac's blue sky multiple increased due to improving demand for its luxury SUV lineup, rebounding dealership profitability, and growing buyer demand for domestic franchises given the administration's policies. In addition to these positive upgrades, Kerrigan Advisors did downgrade one franchise multiple this quarter, namely Audi, due to declining dealership sales and profitability coupled with rising inventory levels. Audi underperformed in Kerrigan Advisors' 25 dealer survey, ranking lower than most luxury peers in both expected franchise value improvement and dealer trust. With that, thank you for tuning into this webinar. Please feel free to email or call me directly with any questions about the information I have discussed. I am happy to have a confidential conversation with you. In closing, I am honored both as an American and a mother of an Army ROTC student at the University of Notre Dame to celebrate our country's 250th year. There is so much to be proud of on this milestone moment, including our incredible auto retail franchise system, which is truly the envy of the world. Happy birthday, America, and thank you again for listening in.
Erin, what a great presentation. Thank you so much for taking time out of your busy schedule to speak with us. We always love having you on and hearing your take on what the market's looking like out there. Again, you'll all be receiving a copy of this presentation and recording by early next week. To learn more about AIA, visit aiada.org. Thanks for joining us and have a great day, everyone.